I've not paid the federal taxes in a while now, and that is not because I am avoiding or I decided not to pay. It's because we understand the tax rules and we are going by the law. Welcome everyone once again to another edition of Ask the Multifamily Expert. And we all know why we do this. We have to constantly stay alert with what is happening in the multifamily space. And this is an opportunity for anyone to ask questions, because it's kind of difficult for you to see someone to ask questions directly on what you're going through your multifamily business or deal. Multifamily is just about team support, teamwork. So this is an avenue for you to know more and to ask questions. So today, it's not a coincidence that we are discussing what is in the big, beautiful bill, as they say. We are going to discuss what is particular to us. Many people have different concerns or different things about the big, beautiful bill, but this platform is not a political platform. But at the same time, there is no way we can talk about multifamily or any form of investment without addressing the policies that govern our business. So we can't afford not to talk about it, but we can afford not to take sides. So as much as possible, we will not be taking sides. We all have our personal concerns or our personal opinion about the big, beautiful bill. We can do that outside this platform, but on this platform, we are actually picking out the benefits to investors. And that's why today we are discussing the big, beautiful bill. We're looking at it with a bigger eye lens. We are looking at the opportunities that we as investors can take as soon as possible, because some of them have a lifespan and some of them are kind of permanent. And so far, I've been able to have engagement with so many investors, especially the passive investors. And I got to find out that most of them do not have good tax or CPA people that file their taxes. And if they do not have it, or if they do not have those people, they might not be taking advantage of benefits that their investments might be given. So one thing I always like to do for people that are investing in the multifamily and the real estate, ensure that your CPA or whoever is filing your taxes is aware of the investments you're doing. So this is where I kind of say, once you started investing a lot of money in real estate, you need to stop using the roadside CPAs, or those ones that they are not primarily CPAs. They don't do that. They are not qualified or professionals in it. They are just doing it as a side hustle. When you start investing in real estate and spending significant amount of money, now is the time for you to look for the CPAs that understand the benefits, because if you're not taking advantage of it, then I don't know what exactly you're investing in. So like I always tell people, I've not paid the federal taxes in a while now, and that is not because I am avoiding or I decided not to pay. It's because we understand the tax rules and we are going by the law. And there are so many opportunities that if you don't know, you don't know. I'm saying this before we dive into what we need to talk about. I always try to tell people, it's not just for you to have a CPA that files your taxes at the end of the year. It's also for you to engage them at least 2 to 3 times or 4 times in a year. So we try as much as possible to have every quarter meetings with our CPA or every 6 months. And the reason we are doing that, because we want to know what are the opportunities on the tables that we can take advantage of now, and what are the things we shouldn't take advantage of now. So for example, we want to sell a property, we get to call our CPA. We want to sell a property. What do you think? Can we write off this? Can we do that? So sometimes I'll say, hold off, don't do that. Or we want to do a 1031 exchange, but we need the money. We really don't want to defer the taxes because we want to take the capital gain and use it to fund other businesses. And they will say, you have a lot of tax liabilities that you can use to write off those capital gain. Go right ahead and sell. Then we'll write it off with your K1s, the ones you've gotten previously. So these are the kind of conversations we have. And based on that, we've been literally able to do so many things because of tax planning. So you know, most of our deals, we do not use cash to do them. We do a lot of withdrawal of equity and we invest them into those deals, or we sell off properties and we invest them. But before we do that, we consult with our CPAs that guide us and we take benefits from them. They even help us to structure our LLCs. I think we have over 15 to 18 LLCs. So it's difficult for us to manage it. So we have an organ chart of all our LLCs, where this is, and that. And that kind of protects us, and it's difficult for liabilities to fall straight down to us because of the way it is structured. And this thing was done by by the help of our CPA, and our CPA brought in a legal professional, a lawyer, attorney that helped us structure our business. And that is how we are able to do things, one, in a legal way, and not just that, take advantage of all the opportunities that we can take advantage of. So please, guys, if you are really investing in real estate, any form, whether single family, multifamily, IT, storage, whatever it is you are doing and it's significant, please get the professional involved. It's not cheap, guys, but it is worth it. It will save you a lot of money. So now let's dive right into the bill. Some people call it big beautiful, some people big ugly, whatever you call it, it's left for you. So we're going to be talking about the different aspects. Before I go on, I want to state clearly that I am not a tax professional. I am not an attorney that is into taxing. So I am not here to give you tax laws or tax rules. I'm only here to educate and tell you it's left for you to go and speak with your CPA and get all the necessary information for what you need. And I also want to state that for everybody, it is different. So what is applicable to me might not be applicable to you. So your circumstances might be different. So that's why you need to speak to someone for your tax purpose. So the next thing we need to do is we'll be talking about the different tax opportunities that were highlighted in the tax bill. I want to state for a fact that this tax bill is very beneficial for those that are into real estate, multifamily, and if you are a millionaire, trillionaire, billionaire, whatever it is. In short, this is a wealth transfer. So if you're not still investing or you are on the sideline, this bill as we have it, at least for the next 3.5 years, is going to benefit some group of people. And it's not on lockdown. You still have the opportunity for you to come in and join the winning team. So every law, every bill, you just need to take advantage of the one that applies to you and run with it. So now there's an opportunity, especially for real estate investor. And if you've not started, come right in. The opportunity is on and it's massive. For those of you that are not following us on our social media platform, take advantage of it. And the reason why I'm saying you take advantage of it is because of the type of terrain we are in. We are constantly following the market. We are seeing the effects of everything that is happening in real life. And we are doing studies, and some of these things is affecting us directly. And we're giving people alternatives or ways we've gone around it. We're putting out lessons learned. We're putting out how these things are affecting us. I mentioned in the past that some of our properties have been affected by ice, but I'm going to give an update video on how we are mitigating those challenges. We are not preventing them from doing their job, but we as investors, we are looking for ways and we are executing on different ways that we can mitigate the risk so that it does not have effect on us. And the ways we used to channel our messages are through our social media platform. On Facebook, it's called Official BBO Fury. We still have a Facebook group, which is Blue Ocean Multifamily Group. We post every day, at least once or 3 times a day. So there's something for everyone. On our Instagram, we also there as Blue_MF Group. If you cannot find Blue_MF Group, you can also find me on Instagram as BBO Fury. On YouTube, it's BBO Fury, and on LinkedIn, it's BBO Fury. So you can catch us and get updated. If you're investing, this is important for you. Subscribe to our social media platform. Today, we have different bills, but I'll be talking about some. One of them is a 100% bonus depreciation. Let me give us a background story about that, what it was before and what it is right now. Before now, in 2017, during the last Trump administration, they created the tax bill, which was supposed to be for at least 3 years, and after 3 years, it started depreciating. So it was 100%, and recently for 2025, it was supposed to be 40%. Now, for those of you that are not familiar with what that is, let me just break it down to a certain extent. So real estate on its own or multifamily on its own can be termed to be a business. For those of you that are into it, the bonus depreciation gives you the ability to write off those items or those equipment, whatever it is that is on a property that gives it value. Whatever it is that can give it value can be written off as long as the value, the total lifespan of those items are below 20 years. So let's take, for example, you have a land. So land cannot be depreciated. So land is equal to 0. Nothing can be done to land because assume that land does not have any value. By the time you start building on that land, you have the roof, you have your sheetrocks, you have your appliances, you have your HVAC, whatever it is. You have your pavement, the road, the curb area, your landscaping area, whatever it is that you have on that property. As long as the lifespan of that property is is below 20 years, you have the opportunity to write it off. For some of you, see, that's not new. We've been doing it, yes. But the thing is, before now, it was set to expire in 2026. But what this new bill has done is that it has reinstated it, and now it's permanent. It means that it's going nowhere, except the Congress comes again, maybe in another new administration, and they decide to take it off, just like the way they've been undoing and doing things. To the best of my knowledge, I would just say for now, look out for the next 4 years. Take advantage of the opportunity. If another administration comes in and undo whatever it is that has been done, at least you've taken advantage of the next 4 years of what the bonus depreciation will give to you. So back to what we're saying. So those things will be depreciated. Before now, a property, a house, a building, not commercial. A building can be depreciated up to 27 and a half years. So for example, you buy a house. It means that you can depreciate it to 27 and a half years. But the fact remains that how many of us live in a house for more than 10 years or even 5 years? Some of us, after living in a house for 3 years, we are already flipping it or selling it and upgrading to another house or downgrading, depending on your situation. So if your case is whatever it is I've mentioned, it's possible that you will not be in the house for 27 and a half years. So the depreciation might not be that beneficial to you. So what do? You have the opportunity to depreciate everything that falls under 20 years in your property. So based on standard, it's typically around 30 to 40% of the value of the entire house. So those things can be depreciated by 100%. That is the opportunity that we have. So for those of you that are closing on deals this year, for us, we closed on a deal last week. So those of you that closed on a deal January 20th, those deals fall under the category. That means you can get a bonus depreciation of 100%. Now, how can you do that? The most familiar way or the most common way how people do that is by getting a professional to assess the value of the property. Because if you are depreciating, let's say some people might just start equating values. Oh, my land is worth this, my personal properties on this building is worth this, my repairs are worth this. It might be challenged by the IRS. So it's important that you get a professional that does cost segregation to help you go through that process. There's one that we use if you are looking for a very credible, professional, and affordable cost segregation expert. Reach out to us. We'll be able to refer someone to you. What they do is they take a study of your property, and this is even more beneficial for people that are doing value add. So for example, you're changing your roof, you're changing your HVAC, you're changing things. Those things will come into play and give you even more depreciation on those properties. For some of you that believe that newer properties gives more depreciation, I would like to say value add even does better. I've been in that situation. We had a 2009 property and we had a 1972 property. Because the plan for the 1972 property was for us to increase the value. We're replacing the roof, we're painting, we're changing appliances. It was a significant renovation. When we did the cost segregation on both, one gave us 4 million, the other gave us 2.something million. So it's really beneficial to value add projects, people that are taking maybe bad houses and turning them into renovating them and doing all that. It's going to be very beneficial for you. So invest in value add projects if you must. That is the benefits for that. You can literally write off. So let me give us a practical example. For example, if you spend 150 upgrading a 20 units, you can deduct the entire 150. Let's say I bought a property for 15 million and I spent about 1 million to do the renovation on that property. With this new tax bill, I can take back the entire 1 million that was spent because I can get back 100% of it. I don't need to wait for 5 to 7 years or 27 years or 39 years to do that. I can take back the entire money that I spent on my renovation to do that. And it applies for properties that were closed January 20th, 2025. And based on the bill, is permanent moving forward. So going forward, we'll keep taking advantage of that. Then the next item, apart from bonus depreciation, is section 179 in the bill that talks about expensing and expanding. This allows you to deduct business equipment. So for those of you that might not be in the real estate or in the multifamily space, but you have businesses and you use equipment, you use computers, you use phones, cars, whatever it is that you use, printers, shredders, whatever it is that you use, this bill will give you the opportunity to write them off. Yes, we had it before, but what it was before is not what it is right now. So now you can quickly write them off for smaller upgrades or equipment purchases. Things like your washer and dryer, if you bought them for was $75,000, you can deduct a full $75,000 for it. Before now, it's at a particular percentage. That is, if you bought a computer, there was a limit to it that you could deduct before you file your taxes. But right now, it is 100%. So now, guys, go and start changing, renovating your office, go and change your laptops, go and buy vehicles for your business, because those are incentives. Those are ways you can get some tax write-offs and use them to write off on your W-2s or things that you need to write off on. I want to also note that some of these things have caveats on them. Sometimes people only disclose the superficial benefits, but sometimes they forget to go that there are conditions. So some of these things I'm mentioning, you need to know if you are qualified. For things like the bonus depreciation, let me tell you how we treat it for multifamily. If we buy a property, we call it a cost segregation expert. The person does the cost segregation study, gives us the report. After we get the report, we send it to our CPA as well as our profit and loss and our balance sheet. We send it to them and file our taxes. They come up with the tax returns, and not just the tax returns, they also give the investors K1s. So because you're part owners of the business, let's say you've invested as a passive investor, you'll be issued out a K1. A K1 might be a negative or a positive loss, but if you are investing right, it's likely that you should have a negative loss on your K1. What does that mean? It does not mean that your property is performing bad. When you see a negative, let's say a negative $100,000, it's a paper loss that you can use to write off your tax liability. So the caveat there, back to what I was saying, is that there are conditions. If you earn over $150,000 on your W-2, you will not be able to use the K1 to write off your W-2 income. And the reason is because the losses in the real estate or the multifamily investment are typically for passive income. So the losses you're getting are passive losses because real estate on its own is described as passive. So for you to take advantage of it, you must also be having passive income. So if you are doing a W-2, you're a lawyer, you're a teacher, you're that, those are active income. You will not qualify for it. The only way you can take advantage of it if you have a W-2 is that you'll be given about, I think, 30% as long as you earn below 150,000. Once you are above the 150,000 threshold, then you need to meet another qualification. So there are different qualifications. That means you must prove that you are a real estate professional. So now there's a way to go about it. I've seen families that restructure their family. Maybe the husband now becomes the tax expert. That means he dedicates his time to actively participate in real estate things. Not an agent. I'm not talking about you being an agent or a broker. No, I'm talking about you managing the operations of the property. So if you are a GP, a general partner, because general partner in a multifamily is described as active. If you are a GP and you spend significant number of hours, above 750 hours of your time, then you qualify. Recently, there was another route for you to qualify as a real estate professional. I think that will have to do with you going through a course or something. I think I heard that it went through, so go and investigate. There are other ways you can prove for you to be a real estate professional. Please, it's very important that you follow the law. Don't cut corners because you can be audited. And once the IRS decides to audit you, it's a nightmare. I will let you know that. So don't cut corners and say you are a real estate professional whereas you are not, because it can raise a red flag and they might decide to audit you. And once there's a loophole, you will pay a serious fine for it. So please, there are ways to go about it that are legal. You can reach out and we can advise you on how to do it, or you can speak to your CPA to tell you what are the things you should be doing right now. So that is for that. So speak to your CPA if you qualify. And if you do not qualify, don't be worried, don't be sad, because as long as you are investing in real estate, regardless of the fact that you are a GP or LP, you will still take advantage of your K1. But the timing now might be different. So for someone that is investing in LP and you have a W-2 and you earn above 150, the question is, so what is the benefit? How do I get my tax benefit from this since I'm not a real estate professional? There are ways you can. So for things like sale, so when a property is sold, it's likely to have capital gain if done well. So let's say you bought a property for 13 million and the people you invested with, the sponsors or the GP, comes to meet you and say, oh, this is 5 years after we collected your money. The property has yielded well. We want to sell. The 13 million property is now worth 24 million. In other words, it's possible that you gained about 11 million capital gain. Now, that 11 million capital capital gain, if you and the people that you're investing with, let's say there's a GP split of 70-30, meaning that maybe you as an LP investor, you have 70% of the profit, and you as the GP, you have 30% of the profit. It means that you're going to have a significant amount of capital gain sent to you because you have 70% of the share. Now, you adding that type of money, let's say you invested 50,000 and you sold the property and you got 70,000 profit from it. That means they returned back your 50 and you still got about $70,000 on top as profit. Now, if you look at it, it feels like it's an additional income to your W-2 and you might need to pay taxes on it. That is where your K1 comes into play. The K1 you've accumulated from the beginning of the deal can be used. So for the fact you got a K1 5 years ago does not mean that it's gone. It can be moved forward until it's elapsed, until you're done using it. So at that point, let's say you invested 5 years ago, the K1s you've been saving on your taxes, because these things will be on your tax returns if you are giving it, because you must ensure that you're actually giving those K1s to your CPAs. That's something some people forget to do. Even if you are not using your taxes, your K1 returns, because you have a W-2 job and you are earning a lot of money, do not disregard it, because it's going to come in handy in the future, especially where there is a capital event being done on that property. So if they are selling and you are supposed to get a gain, because that deal is described as a passive deal, you can use it at that point in time and reduce your capital losses, because those things become passive income. Whatever money it is that's given to you at the time of sale is passive income. So remember, I said you can only use passive income to write off passive gains. At that point, that becomes a passive, so you can use that to write it off. So, but speak with your CPA for you to know how to use it. But my point here is, don't throw away your K1s. Give it to your CPA. They need to put it in your tax returns. You can decide to use it in the future, or when the structure of your family changes, or maybe you decide to retire 2 years down the line after you invested and you are now fully into real estate, it can come into play. So please start requesting for your K1s. And if you filed your taxes and you've not gotten previous K1s, you might need to collect them and do some amendments. You need to have those K1s in your tax return so that you can be able to take advantage of it in the future. So for people that are into that, that is a benefit you can use. So back to what I was saying regarding the expensing and expanding. If you're into businesses, now you can write off 100% of your equipment, whatever it is, even vehicle. So if you have a business vehicle, before now you could write off an amount, and not all vehicles qualified for it, especially vehicles that are heavy vehicles like G-Wagons, trucks, and all that. Those were the conditions then. Please go back and check what the new conditions are, what vehicles you should be buying for you to take advantage of it. So that is for that. If you need to start buying equipment for your property, you can take advantage of that because you get a tax write-off. So that's for that. Energy efficient building credit. This is about the energy efficient. Those of you that have been following the news, you are quite aware that the Build Back bill that was done by the Biden administration in 2023, I believe it was done in 2023 or 2024, was actually repelled back, as in this administration decided not to move forward with it, although they are giving a strict timeline for people to quickly take advantage of it. At least for the next 1 year, there's an opportunity for you to take advantage of it. It's not completely dead, but after 2026, July 2026, it's unfortunate that that is gone. Let me not comment on this. I said it's not a political stage, but this is a good opportunity for some businesses or some people to benefit from. This is supposed to be a tax credit for buildings and renovating energy efficient properties. For new properties, if you've noticed, we're having enough energy efficient items, appliances in our homes, even smart homes, smart that. And the motivating factor before now was because you could literally get a large chunk of money from it. So the way it was done before is that credit of up to 5,000 per unit was given for those kind of low-rise apartments, especially for single families. People were taking advantage of it. Developers were making a lot of money from it. So it was a good incentive for people to go into energy efficient buildings, energy efficient programs. You could see solar systems. People were putting up solar systems in their houses because they could get a lot of money from it. But guys, sorry, by July 1st, 2026, that is going down the toilet. So if you've not taken advantage of it before now is the time. time. Make hay while the sun shines. You have a limited time to take advantage of it. Do that ASAP. And it is found in the section 179D and 45L of the new bill. It is time sensitive. Please do that now. It's a massive tax cut, so please don't allow it go. Take advantage of it. So the next one is business interest deductions. It allows you to deduct interest on your property loan. So I know majority of us are not Bill Gates or Elon Musk. Most of us don't buy houses or cash. We take loans from the bank. People like us, we take loans from the bank. We finance our properties. If you fall into my category of loan takers, the people that take loans, come on board. If you're in that category, you can literally deduct your entire interest on that loan. So for example, you bought a property in December 2024 and you are paying an interest of 50,000 monthly. So it's going to be 50 times 12. Let's say you pay 50,000 monthly. So it's going to be 50,000 times 12 months. The entire 50,000 times 12 months can be deducted before your taxes can be filed. This is significant because you can take off a large chunk. Before now, if your loan amount, your loan interest was about 200K, the old rule will only allow you to take a portion of it. So if you had a loan of about 200K, you could take about 150, not the entire 200. But right now, you can deduct the full amount. That is massive. Guys, you know, when I started, I said this is wealth transfer at its biggest form. If you are paying interest on your property, single family, multifamily, whatever that is, let's say your income after you've deducted your expenses and you make an income of, let's say, 500,000, your mortgage expenses is 400. I mean, your mortgage interest is 400. It means that before now, maybe you could take a portion of it, maybe 250 or 300 deductions. But right now, it's the complete 400 interest loan. So 400,000 will be deducted from the 500. It means that you can only file tax on the 100,000. And imagine if you combine that with bonus depreciation again, it means that you are paying 0.0000 taxes. So one of the things that take up our money, for those of us that know that pay high taxes, is taxes. So if you're able to reduce that or totally eradicate it from your life by doing all these things or taking advantage of it, that's wealth transfer on its own. So please start investing in multifamily or real estate. The next one is the qualified production property. This is really about for mixed use, multifamily, industrial to housing conversion, for construction properties as well. So this is a new tax category allowing you to deduct 100% bonus depreciation for real estate used for manufacturing and refining. So if you're in the manufacturing business or you intend to start, I would advise that you go ahead and start right now because you can take advantage of the 100% bonus depreciation. So you know, if you are doing manufacturing, you are investing in this type of thing, it shows that you have money to do investment. So typically, these tax benefits are really for the wealthy. If you know, you know. So that's for that one. The next one is the R&D expensing for innovative projects. Some of you might say, I'm not into real assets like buildings, but I'm into technology, softwares, design, the real estate part of it. You also have the opportunity to take advantage of it. This is beneficial to developers using smart buildings, systems, process, sustainable designs. Small firms can apply this retroactively from 2022. So if you have been into this since 2022, it's a retroactive benefit. That means you can go back and reclaim the benefit from 2022. So if you fall into that category, you can take deductions from it. So if you spend $50,000 developing a small energy dashboard for your property. So for those of you that are into the IT business, this is for you. You can deduct the entire 50,000 right now, even if you started in 2022. So go back, go and check what are the things you did in 2022, 2023 to date and see if you can get those deductions. So in summary, for bonus depreciation, what is it right now? Right now, it's an 100% deduction on improvement in year one, and it starts from January 19th, 2025, and the expiry, it is permanent. What is the benefit of the bonus depreciation? It's going to boost early cash flow. Because you can deduct a lot of money, a lot of bonus depreciation, it means that we can now give investors more cash flow. So because we are not going to pay taxes on majority of our income because of this bonus depreciation, it means that we can give out more cash flow to the investors. So this will really help people investing in multifamily to give out more cash flow to them. For the section 179 expense, and the one I talked about, equipment that you could write off, what this does, the benefit is that you can immediately write off business equipment, and it starts from January 1. So take note of the timeline, very important. January 1, 2025, and it's also permanent. The key benefit is that you can write off smaller items faster. Before now, it was not that easy to do that. The next one is 179D/45L credit. What is that? That's the energy one I spoke about, the energy efficient program or buildings. The credit that's attached to that is currently ongoing. It's going to expire in June 30th, 2026. That is very time sensitive. Check your house and see if you qualify. The key benefit is up to 5,000 per unit. So you can get those tax benefit from it. It is time sensitive once again. Interest deductions. If you're paying mortgages, what this does is that you can get more tax interest. It will help you deduct more tax and more interest on your loan, and the start date is from 2025. So for your 2025 mortgage interest that you've been paying to your lender, at the end of the month, for those of you that are not aware, your lender is supposed to issue out a mortgage loan interest statement. They send it to you every month, and if you've not been looking at it or you don't understand what it means and you've not been taking advantage of it, it means that you have been trading off money. You've been leaving money on the table, because it's been on before now, but not in this massive way. Before now, I think we could not get 100% of it, but right now we can. And if you've not been doing it, talk to your CPA and see if you can start deducting your interest loan from your income so that you can file your taxes. This will help save taxes on value add or bridge debt, and it's permanent. The next one is QPP new, 100% depreciation on industrial real estate. If you're in the industrial real estate, mixed use, mixed house investment, this is for you. From January 19, 2025, it's going to expire by January 2031. It will help mixed use or industrial multifamily. I have mixed use where I have residential and also commercial all in one. We'll be taking advantage of this as well, because this will benefit us. R&D expensing. This is for IT, tech, R&D costs instantly. This is retroactive. This is beautiful because you can go back 3 years from now and go back and take the benefit. It's going to encourage people that are innovative in the multifamily space, design, IT, and all that to benefit. So this is a summary of what are the benefits that you can get from this new bill. Let me put it that way. So in wrapping up, I would advise that we start speaking with your CPA. Start to speak with your CPA. I do that. I speak with my CPA minimum 2 and maximum maybe 8 or more a year to plan my year. Sometimes to tell them about if I'm selling, refinancing, if I am investing. Even the deal we closed on last week, I had to consult with our CPA for them to be aware that that is coming and to give any advice that they can give or any structure we can build in before the year wraps up. So please guys, it's time for you to get the qualified CPAs to do your taxing. If you're looking for one, reach out to us. We can refer ours to you and all that. I hope this was good to you. In our next episode, we'll be discussing what are the factors affecting the multifamily space right now. There are so many things. It's like every day we're dodging a bullet. We're doing the matrix style on our investment. This is not only for people investing in multifamily or real estate. It's affecting both people in the bond market, people that are investing in the gold market, people that are investing in the stock market. So we're going to highlight what are the different things that are happening and ways you can mitigate the risk. Like I always say, macro things that are outside our control. Politics, war, tariff, policies, government change, elections. These things have effect. I always say it and I'll keep saying it. They have direct effect on investment. Some are positive, some are negative. But regardless of what they are, because we do not make them or manufacture them, it's important that we know how to mitigate them. I want to state also that it's possible that we cannot 100% eradicate them, but we can mitigate the risk. And what other way for you to be able to do that is for you to be aware of the issues and start projecting what the implications will be. So in our next episode, we'll be discussing the different challenges, the ones that we know that will come up. Like now, there's a projection that inflation, in short, stagflation might come up. And that is because of the numbers of the data or things that are happening now. So since we are aware that that is likely to to happen, what do we do? What is stagflation? It's more about increased unemployment and inflation alongside. If that is pictured to happen, what do you start doing now as an investor to mitigate the effect? So in every circle in investing, there's an opportunity, but you might not be able to see it with your clear eye. You might need to look deeper to see it. And this is where we'll share those opportunities for you to know and for you to start doing things. Lastly, if you've not subscribed to our YouTube channel, it is Bibi Ofiri. And if you've not subscribed to our Facebook, it's also official Bibi Ofiri. We encourage that you do that, because every time we put in videos that are educative and can help you understand exactly what is going on. And one thing we always try to do is to uncover things. Like a video will soon come out next week, and with that we're going to show you our property that ICE came to take about 7 tenants. Because they took 7 tenants, 17 more of them left. You'll see the video on how we are able to mitigate that, what we've done so far to address that. And this is for a property that was 100% occupied, guys. And this is not unique to us, it's going round and all that. Yes, Jessica, I see your question. You said, do you have a CPA firm you can recommend? Yes, I do have a CPA firm that I can recommend. Reach out to us on any of this platform. You can send me a message on Bibi Ofiri on Instagram, a private message. You can DM me there. You can send me, if you're on our WhatsApp channel, you can also get my number on WhatsApp and send me a direct message, and I will recommend our CPA to you. And you can go ahead and set up a discovery, because they would like to do a discovery call with you to see your case and advice on the way forward. So thank you all for your time, and I hope you enjoyed this. I look forward to seeing you in the next episode, where we are going to address real life issues. Thank you all and have a wonderful day.